Welcome to this week's Financial Tip Tuesday. I thought it would be beneficial to walk through some things that you need to think about when you're picking your investment options inside of your 401k or 403b plan. So if you've ever been nervous or confused or not sure what to do, then this video is for you. If you find this video helpful, I would love it if you would subscribe and hit the like button to help the YouTube algorithm get this video out to more people who could benefit from it. So let's jump right into it with a real life example. I pulled up the investment options from a previous retirement plan that I used to have money in before I rolled it over to my IRA. And there's two ways to think about investing inside of a 401k 403b plan. The first option, which is the most simple, is a target date fund. So the majority of plans nowadays have target retirement date funds. And what they do is as somebody gets older, they gradually get less and less stocks and add more and more bonds into the portfolio for you automatically to make it less risky or less volatile as you get older and closer to retirement. So this particular plan has target retirement date funds that start at 2005 all the way to 2060 when somebody might retire then. These retirement options are really great for people who don't really want to think about it, don't want to put a lot of work into it. It's just kind of a set it and forget it type thing. And most plans that I've seen are actually defaulting people into these target retirement date funds. The expense ratios are a little bit higher than what I like with index funds, which you can get lower, but you're doing less work, so you're paying a little bit more money for it. That's the first option, and it's a great option, but I think there is a better way to do it, and that would be option number 2. If you are willing to put in a little bit more work on the front end, I think it can be very beneficial for you down the road. So with option number 2, the first thing you need to do is evaluate your risk tolerance and risk capacity. So your risk capacity is how long do you have until you retire, where the risk tolerance is more so how okay are you with the ups and downs of the market and can you tolerate that? So there's a lot of free questionnaires that you can take online if you Google them. I'll leave a link to a couple below. And so once you evaluate that, for a lot of younger people, if you are okay with it and you can tolerate it, 100% stocks could be the way to go, but it's obviously going to be a lot more volatile than if you add in some more bonds into your portfolio. And so instead of with option 1, you have the target retirement date fund that does it automatically, where with option number 2, you are going to have to actually manually do that and adjust it down the road. So they give you a few different options. As you can see on the screen here, they have small cap, which are your small size companies, mid cap, which are your mid size companies, large cap, which is your large cap, and then you do have some bonds as well as a money market fund. And on the previous screen with the target retirement funds actually had the international funds as well. And here is the big secret. Nobody knows or can predict exactly which category is going to outperform over the next few years. And so you want to build a nicely diversified portfolio. Some years, small companies do better. Some years, large companies do better. Some years, international companies do better. Some years, bonds do better than stocks. It just depends. So you want to build a nice balanced portfolio. When I'm thinking about this, usually large cap, large size companies are a little bit more stable. And so we usually recommend maybe a little bit larger portion in large cap, and then a smaller portion in mid cap, a smaller portion in small cap. And with your international portfolios, some people recommend 10%, some people will recommend up to 40%. Again, it's hard to say what years the United States is going to outperform versus what years the international companies are going to outperform. So here is an example. And let's say you might want to decide to do 40% large cap, 15% mid cap, 15% small cap, and then the other 20% international. That could be a nicely balanced portfolio for you. Your coworker that sits next to you or that you work with all the time, they might do something different. They might think that larger cap is going to be better, and they might want to do 70% large cap and 10% in the other three, in the mid cap, small cap, and international. And again, I want to reemphasize, nobody can predict the future, and we don't know exactly what is going to happen. So it's hard to say which one of you are going to do better. But by having 100% in the market versus having more in bonds like the target retirement date funds, I think you could be better off by doing it that way. So now let's say you've chosen to do option number two and you've decided your percent of how much you want in large cap, mid cap, small cap, and international. Now let's dig a little bit deeper into what options this fund offers inside of those different categories. So let's start with small cap. And so you can see there are two options here for small cap, the American Beacon Fund and the T. Rowe Price Fund. And you'll notice that the expense ratio, that's how much you're paying the fund for them to manage and pick what investment options you have, are listed there. So the American Beacon one, the expense ratio is 1.21% per year. And the T. Rowe Price is about half as expensive, 0.66%. And so while expense ratios aren't everything, I am somebody who kind of leans to control the things that I actually can control. So I can control which funds I select and how much I'm paying to be invested in those funds. So for this particular option, I would probably go with the T. Rowe Price Fund. Let's move on to midcap. They offer three different options here. They have the Fidelity Extended Market Index Fund, which is 0.04%. They have the JP Morgan Fund, which is 0.73%, and then the T. Rowe Price again, which is 0.61%. Now, the Fidelity one is quite a bit less expensive, and that's because it's an index fund versus a actively managed mutual fund. And so I prefer index funds. I think it's really hard to kind of time the market and pick and choose. And so I'd rather pay a lot less money with not having to pay an investment advisor for an actively managed mutual fund. So for this option, I would go with Fidelity Extended Market Index Fund. And then the next one, the large cap, again, there's three different options here. The Fidelity 500 Index at 0.01%, almost practically free, just a little bit of an expense ratio. They have the John Hancock, which is 0.65, and then the Mainstay Winslow, which is 0.71. So again, I would choose the Fidelity 500 Index for this option because it's practically free, and you're very diversified in your investments. Those are my thoughts on how you should go about thinking about investing inside of your retirement plan at work, whether it's a 401k or 403b. So hopefully that helps. I do want to remind you that, again, none of us can predict which asset allocation is going to be the best 5, 10 years from now. So I'm encouraging you to control the things that you can control. So that would be the expense ratios, which funds are you picking and how much you're paying to be invested inside those funds. You can also control your investing rate or the percent that you invest. So that would be how much you're contributing per paycheck or per year. And then the third thing, you can also control when you start investing. The younger and the longer you have for the money to compound and invest, the much better off you're probably going to be. So instead of analysis paralysis trying to pick the exact perfect percentage of the asset allocation, it's much better off focusing on those other three things that you can control. So hopefully that is helpful. I hope everyone has a great week. Feel free to like and subscribe to help get this video to more people that will hopefully learn from it. Have a great week.